Welcome to the final webinar in our fall series, which is our Santa Monica series. We have a fabulous topic today on inflation, low yields. We've been talking a lot about that already, and digital assets, the boom there. Lots of perspectives to share with you this morning, and in a really kind of a forward-looking way. There's some game changers out there, and that's what we're going to talk about, and how you can start thinking about repositioning your portfolios. So before we get started, I want to just mention, as I always do, that the thoughts and perspectives and opinions that are shared with you today by our speakers are their own, not necessarily those of the firms for which they are working right now. And I certainly want to thank all of our sponsoring firms that include O'Brien Investment Group, Efficient Capital Management, InnoCap Managed Accounts, Bodie Research Group, Graham Capital, Martlet Asset Management, Vidrio Financial, Welton Investment Partners, and I feel like I'm leaving somebody out, but I did not. Hooray. Okay. And then our association partners, we have partnerships with AMA, CASA, and Kaya, for which I'm very, very grateful. And that's it for me. I'm going to turn this over. Marat, Katie, Mike, and John, come on. And let me turn this over to Marat, who is going to really get this thing revved up. Have a great session, guys. See you later at the end.
Thank you, Meg. Thank you, Ken. Hello and welcome, everybody. My name is Marat Moliboga. I'm the Chief Risk Officer and Director of Research at Efficient Capital Management. For over 20 years, we have been specializing in building customized multi-manager solutions for institutional investors. We allocate about $2 to $2.5 billion to trend followers, global macro, and diversified CA strategies. Although we have a little bit of exposure to digital assets because our managers do trade Bitcoin and Ethereum futures, also done quite a bit of research on the digital asset space in the last 12 to 18 months. I'm very excited about this event for a couple of reasons. One, I think the topic is very, very important. So if you've done any work on your house in the last 6 to 12 months, if you've tried to buy a bicycle for your children, or if you keep track of milk prices like I do, you know that inflation is real. And just a couple of months ago, the Social Security Administration approved a 5.9% cost of living adjustment, which is the highest level since, I believe, 1982. So inflation is real. And we also know that expected returns are pretty low. The stock market is at all-time highs. The government yields are close to all-time lows. So it's very difficult for investors to generate real returns that are even zero. So it's a huge challenge. And the second thing is the digital asset space is fascinating. We've seen an enormous explosion of this relatively new industry. Just a couple of years ago, its size was roughly $250 billion. And November of this year, it crossed the $3 trillion mark. So it's pushing enormous growth of this really fascinating industry. And the second reason why I'm excited about this event is because we have a fantastic panel of really highly skilled and brilliant and thoughtful investors, and they represent three types of asset management firms, and I'm grateful that they can actually add their own perspectives to this discussion to make it more interesting to the audience. We're going to give them an opportunity to introduce themselves. I'd like to say a couple of words about each of them. I'm going to start with Katie. So I'm a huge fan of Katie. Katie is such a thought leader in our industry, and I really enjoy hearing her thoughts on a wide range of topics. And one suggestion I would make to all of you is that if you don't know a lot about trend following, please go and read her book about trend following. It's absolutely fantastic. I'd like to mention a couple of things about John. Yes, that book.
Thanks, John.
It's really, really good. About John is also a very thoughtful guy. And what most of you don't realize is that, or don't know about, is that John actually made a very significant change to the way institutional investors are thinking about building their portfolios. He came up with a concept of crisis risk offset, which is used by some of the most sophisticated public pension plans in the U.S., including, for example, CalSTRS. So I'm really excited to have him on the panel as well. Mike is from O'Brien Investment Group. I don't really know, unfortunately, Mike as well, but I know he's also very thoughtful, and I really look forward to hearing his thoughts, particularly on the digital assets, because I think it's such an important topic. So at this point, I want us to go a little bit deeper and get to know our panelists better. So Katie, could you please introduce yourself, your firm, and your role at the organization?
So nice to be here, Marat, and see you again virtually, hopefully in person soon. My name is Katie Kaminsky. I'm the Chief Research Strategist and Portfolio Manager at Alpha Simplex Group. Alpha Simplex is a quantitative investment manager who has specialized in a range of quantitative strategies. In particular, we are also managing one of the larger managed futures funds in the space. So myself, I have a long background being really interested in quant finance, but also very interested in trend following and systematic trading. So I think it's a lot of fun, and I'm excited to be here today to talk a little bit about some of those themes we're seeing this year and some of the research and ideas that we might be able to take forward into 2022.
John, could you go ahead, please?
Yeah, thank you, Marat. And I want to thank Meg Bodie for having me on today. Always a pleasure to work with this organization. John Linder, Managing Director of Business Development at SLC Management, the asset management subsidiary of Sun Life Financial. As Marat indicated, the genesis of the crisis risk offset class was something that I came up with my colleagues at Pension Consulting Alliance, now Makita, back in 2014-15 after the great financial crisis. And just to mention, I'll be leaving SLC Management at the end of the year to pursue activities in the crypto sphere. I really do believe this space is really the future of finance and also the future of the internet, or an integral part of that. So that's where I'm headed, and clearly the opinions of that I'm representing on this call are mine, and they are not those of SLC Management.
Thank you, John. Mike, could you please introduce yourself as well?
Yes, thank you, Marat, and good morning. I too want to thank Meg for putting on this event. I think the work that she's done in the last 18 months is kind of helping our industry with these virtual conferences has been tremendous, especially during the lockdown. And we're looking forward, Meg, to working with you in 2022 as we get to in-person events again. My name is Mike Stenler. I'm the Managing Director, Investment Committee member for the O'Brien Investment Group. I've been in the investment business since 1984. I started out working in the brokerage business, later working on a $4 billion small cap value fund. 18 years ago, I switched over to the global macro trading space, and I've been with O'Brien Investment Group since we started the company 5 years ago. We have two funds. One is a quantitative diversified strategy, global macro, that trades both financial and commodity markets. It's a combination of trend, momentum, multi-time frame, machine learning, and option models that we write covered options, both puts and calls, into events, and when implied volatilities are high. We also have a digital asset fund. The digital asset fund also trades quantitatively Bitcoin and ETH futures, but we also have a couple dozen smaller DeFi tokens that we will trade. I'll share a little bit more about the trading aspect of it, but it's certainly diversified, long only on that part of the portfolio.
Thank you, Mike. We have a lot to cover today, and please forgive me if I'm going to cut certain parts of the conversation short because the content is so significant. So we decided to break this discussion into really three portions. The first part is going to be dedicated to the overall macroeconomic environment, market outlook. We're going to talk about repositioning portfolios. Then the second part is going to be dedicated to the digital asset discussion. You know, what is the digital asset space, and what would be a good way for institutional investors to access the space. And also, we're going to talk about some of the challenges that institutional investors are wrestling with. And then finally, we're going to talk. We're going to hopefully have time for the Q&A portion. It might be short if we run out of time, so please forgive me for that if that happens. We want to make this discussion interactive, so please submit your questions in the Q&A portion, and also please respond to the poll questions that Ken is going to put on the page. And the goal for the poll questions really to help us tailor this discussion to make this discussion as useful and as productive for you as possible. So please help us in response to the poll questions. So at this point, we're going to jump in, and we're going to start with this very challenging debate of the inflation. Is it transitory or it's persistent? And we're going to start with Katie. Katie, what do you think?
So I think this is a great question, and it's an example of how finance loves to use words as weapons. Because the word transitory is in the eyes of the beholder. So what has been fascinating to me is that transitory depends on what you're talking about. So if you look at an economist, transitory could be 20 years, could be 30 years. So, and it also depends on if you're talking about the level of inflation or changes in inflation. And I think the problem is we've kind of put it in two boxes, transitory, persistent. And so I actually think there's a much more wide range of views about inflation out there. And some people who actually have the opposite response to that question, persistent and transitory, actually have the same expectations. And so from my perspective, if you look at a long-term perspective, the general view is that inflation is transitory if we have the opportunity to eventually modulate it. And you maybe think from the Fed's perspective, that's how they're thinking about it. But the market is much more short-sighted. The market is much more about transitory is 3 months, transitory is 4 months, transitory is something that means it's over quickly. And so from my perspective, I think that question is sort of depends on your perspective and your time horizon. So I think from a short-term horizon perspective, it looks persistent. From a longer-term horizon, it actually might be transitory. So I think we've gotten caught up again, and we do this often in finance, in describing things with very simple terms. And so from our perspective, inflation is here to stay with a shorter term horizon. And we're going to have to continue to think about how it's going to percolate through the asset classes we trade over the next year, in particular, when we couple this with the rising rate narrative as well. So we can maybe hear a little from my fellow panelists about this thought, what they think about it. And I'd love to come back to talk more about rising rates in a second. So I'll turn that to my colleagues here and their thoughts on transitory or permanent or persistent.
I have a question. Yeah, and this is great. So, I mean, of course, it's really difficult to define, what it means. What the term definition is important, right? And I think that I think for the purpose of this discussion, I think we want to be practical and think about what does it mean for investors for the next 12 to 24 months, maybe. So what I'm hearing from you, Katie, is that you think that inflation is here to stay at least for the next 12 to 24 months. But of course, there are lots of unknowns. There's a lot of volatility around this expectation. So John, I'm just wondering, can you think, what are your thoughts? And also, can you really visualize scenarios that would lead to inflation being very transitory?
Well, okay. So, we had a call yesterday, obviously, and discussed this question. I really gave some thought to it. And I think that, what I'm thinking is that inflation is going to be persistently higher than interest rates. And so that is not necessarily the end of the world. And I believe that's the way the Fed wants it. In order to effectively, continue to buy down rates, they're going to hold, and they want inflation to be above the level of rates, and they are able to hold rates down while inflation, runs higher than rates. But there's likely to be a policy error. If and when the market effectively determines that, that there needs to be a shift. And so I think that it's really path dependent, and that's going to cause a lot of volatility. So I actually don't see that we're going to have runaway inflation, but but we're going to see inflation higher than rates, and the Fed is going to be certain that they hold rates down below that level. Whether that level is, the level of inflation, I kind of think we're peaking at inflation right now, but it may be uncomfortably high, and it certainly will be higher than the level of rates.
Right, and I think we've seen really low levels of inflation for so long. It would not be surprising if the new level could be higher than what we've seen. So, Mike, I'd like to hear your thoughts, but before we do that, Ken, could you please bring up the poll results for the inflation transitory versus the other one as well about? Perfect. So, Mike, I'd like to hear your thoughts, but also I'd like you to maybe also reflect on the answers from the audience and what it tells you about what investors anticipate going forward.
Can I just offer that this is a turnaround from 6 months ago?
Absolutely.
Murat, I thought the poll was interesting because I think it said 93% persistent and 7% transitory. So maybe it goes back to Katie's comments of what is your definition of transitory and what's your definition of persistence. And I think also it adds into at what level is high inflation and what level is kind of the new norm, or what is the rate. David Balin was CIO of Citi, was on Bloomberg this morning. He was in the transitory camp, but he also said that he believes inflation will run at 2.5% for the next decade, certainly suggesting that the levels we've seen for the last 10 years might be substantially lower, or certainly lower than what we're looking for going forward. I'm in the camp that we're in the persistence, in the sense that the last 9 months we've seen higher inflation. It might take another year for the supply chains, et cetera, to work their way out. But I think all of that's going to produce greater inflation. Are we at peak at 6.5, 7? Maybe so, but it might be grinding out substantially higher than what we've seen. I think there's a lot of factors at work. Wage inflation is certainly one that's being talked about. The argument that commodities have rallied and they're going to come off, and gas prices are going to come down, prices are come down, certainly a possibility. But wage inflation, once it happens, it certainly doesn't revert back. John Deere just settled their strike. 14,000 workers had a 10% raise with future raises coming. The conference board is suggesting wages are going up 3.9% next year. So certainly well above the averages that we've seen for the last decade. I think some of the global changes as it relates to climate change, ESG, and the deglobalization are also going to be inflationary effects to them as we shift away from coal, natural gas, to more electric. I think there's going to be spikes in inflation. I think you've seen that a little bit with energy producers in Europe, and I think you're going to see that as well in the United States. I think ESG making it more of a challenge for capital to flow into oil and gas in the United States. I think it's going to have an impact on it. So I think all that, and I think the deglobalization, one of the reasons I think inflation's been low the last 30 years has been the globalization as well as productivity gains. I think now that you see the kind of deglobalization bringing back medical supplies in the United States, bringing back chip manufacturing in the United States, all that, I believe we're moving from a low cost, lower regulatory environment to a higher cost, higher regulatory environment. And all that, I think, is going to have an effect on inflation as we look forward for the next 2, 3, 5, 10 years.
Yeah, that is so interesting. I think you make some really good points. So one of the reasons, you're right, one of the reasons we had relatively low inflation was because the world was so globalized, and the pandemic showed that it's not really a very robust system. And I think we're going to see more deglobalization going forward, because sometimes epidemics happen, and it becomes much more difficult to rely on foreign partners. So maybe it's a long-term shift that's happening in the economy. And I'm fascinated about your comments about commodities. I want to come back to those later, because I think it's going to be a very important topic as well. So I'd like to go to the market outlook. So the polls show that most people behave that the future is going to be very different from what we've seen in the past, that the asset classes are going to perform very differently going forward. And I know, Katie, you've done some work on that. Do you mind sharing your market outlook for different asset classes, maybe risk premium for 2022?
Yeah, so I would say that the three themes that we're looking at, first is that inflation worry is going to continue. Second, that long and short-term objectives may be at odds from time to time. And third, that rising rates is a real issue. And so if I look more at the type of signals that we've seen in some of the asset class, sort of the signal strength that we've seen in terms of market moves in the last year, this gives some indication of these changing themes. So, for example, we've definitely seen a lot more short pressure in the fixed income sector, which is indicative that we are probably eventually going to finally see the end of that great bull market in bonds, and we might actually realize a real trend in terms of rates rising next year. And then another thing that we're really keeping track of would be commodity moves. One of the things that was fascinating to me is that in 2021, the signal strength in terms of long positioning for commodities across all sectors was at a contemporaneous high, meaning that for history of a trend follower like myself, we're seeing extremely strong signals on the long side for all commodities with the exception of precious metals simultaneously, something that is really indicative that the market has really been moving aggressively with this inflation theme. And so finally, to kind of summarize some of the research out there and things that investors need to think about is that a rising or an inflationary environment is very different than the asset class environment that we have all been enjoying for the last anywhere from 20 to 40 years, depending on how you count it. And most of us, unfortunately, don't remember periods where you had very different asset class relationships. This year, we saw positive stock bond correlations over certain periods of 2021 over short horizons, which is indicative of a typical relationship we've seen in a high inflationary regime, such as the 1970s. So back in a higher inflationary regime, you see equities struggling a little bit. You also see bonds having a lot more headwinds, much more challenging for nominal bonds in high inflationary environments for some obvious reasons. And you also see that commodity trends are much more pronounced and much more interesting, both on the upside, but also on the downside, as you have volatility in inflation. So I think our biggest view is that macro volatility, and my view as well, is that macro volatility will be higher, that asset classes will perform differently, that asset classes that we have forgotten about or maybe not thought about in the same ways may need to be treated in a different way, especially as duration risk becomes a major issue. We all forget that the R is on the bottom of the equation. So if that moves, we've got massive moves. So, really the big denominator is going to be rates and where they go, and also how inflation affects different asset classes and different sectors differently over the next year.
No, that is fascinating. I think that as we discussed, it's likely that inflation is going to be persistent, and for somebody who is thinking about positioning their portfolio, they have to consider the implications of that. And as you know, most institutional investors' portfolios can be proxied by a typical 60-40 portfolio, which was a great strategy for the last 40 years because we had two asset classes that perform extremely well individually, but in combination, they perform even better because of the negative correlation between stocks and bonds. But if during an inflationary period, stocks and bonds are going to struggle and they no longer offset each other's losses, that could be a very significant problem for all investors. So, John, I know that you have really great expertise in the fixed income space. And I think that a lot of people are trying to figure out what to do about the fixed income exposure because the yields are low. Maybe that negative relationship is not there anymore. Can anything be done about it? Like, how should investors think about it?
Well, it's a conundrum, Murat. And what I would remark is that clearly the starting point we have here of at the 5-year point on the real yield curve, negative 1.5%, expected real return. At the 10-year point, a negative 1% expected real return. And at the 30-year point, a negative 0.5%, expected real return. Those are not starting points that you had in 1980. you had real yields, probably 5-6%, during the volatile years, even on the 30-year. And so, who should invest? Nobody should be making investments in negative real yield, instruments at 30 years. Now there are people that need to, that must, insurers such as my parent company, LDI investors, that are, in an accounting regime that basically they're more interested in managing their income statement volatility than they are in managing effectively their real return. But effectively, most people that have a real return requirement for their institution should, I'm not saying they shouldn't hold fixed income, but it's a trade, not an investment. So spread investors, yes. Corporate pensions, yes. Insurers, yes. Investors with real return objectives, rates are a trading instrument. And, also, what I will say is that their trading instrument, and they want to hold some long effectively because of their offset attributes. They're still going to be the asset that, when all hell breaks loose, they're the flight to quality asset. And I believe that they're going to, in the tail, they're always going to maintain that function. But not in tail events, I think that negative correlation is going to be suspect.
That is a very interesting point, because what you're saying, even though the correlation can go from negative to positive, at the same time, in case of tail events, you still believe that particularly U.S. government bonds are going to be a good hedge to stocks. Well, that's
yeah. If basically we have a growth crash, or that becomes the overwhelming concern of the market, say the Fed were to jack rates tomorrow, the stock market will crash, and there will be a flight to government bonds.
Got it. Fascinating. Okay,
Long
Mike, I have a question for you. That's something that I've heard a lot from institutional investors, because they say, look, we understand that commodities are considered to be an excellent hedge to inflation. At the same time, we've seen some very significant moves early this year, like natural gas price went up, like a lot. Oil price went up. I mean, all the commodities went up significantly. And the question is that they ask is it too late to join? Is it, how far can commodities really go? Because they've done so much already this year. So what do you think about that?
It's been an interesting conversation. We certainly agree. Commodities have had a big run the last 15 months. Our flagship strategy, much like Katie's, has a directional / trend bias on the commodity side. It's hard to find a commodity that isn't pointing to a long position. And a lot of people have said now commodities have rolled over. Natural gas and crude oil obviously are an example. Probably the more poster child one earlier this year was lumber. Everyone was talking about lumber prices. And obviously they skyrocketed, and it affects home building and remodeling and all that. And they definitely did peak, and it was a crazy chart. And they came off, and everyone said, see, commodity prices have rolled over. Keep in mind, lumber prices are still twice what they were a couple of years ago. And a lot of the commodities have come off their highs, but not substantially. You have coffee that's at a 10-year high, cotton still at a multi-year high. Wheat prices have gone from $4 to $8. Soybeans have gone from $8 to $12. So a lot of the movement has occurred, and maybe it stopped going up, but at the same time, we're still at pretty elevated prices. I think in the case of crude oil, JP Morgan a week or two ago came out and suggested crude oil prices will go to $125 to $150 in the next 12 to 24 months. So that is certainly leading to suggest the commodity rally or super cycle, whatever term you want to use, is certainly not over yet. And I think we're in that camp. I still think we have room to run on some of the commodities. There's the stereotypical commodities that can reference frequently copper. We're going to have this huge build out on EV charging, et cetera. That's going to have a huge demand for copper. So a market like that can certainly continue to rally forward. Food prices will continue to get supported. Part of it will be supply disruptions. The other part will be just global demand. So we're a believer that commodities aren't necessarily going to revert back to 2019, early 2020 prices, that they're certainly going to stay elevated. And in some cases, we believe there's going to be enough demand where it's going to push prices even higher. Nat gas might fall into that category. One of the other markets, I think, and I guess, is it a commodity? Is it a financial? I don't know. But EU carbon credits, for example, we trade those. By the way, look at the chart. It's been a heck of a move this year. It's gone from 30 euros to 80 euros. That is an offset for European companies that are emitting the pollution. The utilities have been forced because of electrical demands to buy carbon credits. Heavy manufacturing firms. That's kind of a sign, and I think it's one kind of reverts back to our previous conversation on inflation, but also kind of a demand that's going on and kind of a poster child for the global economy, particularly European economy. So I think you're going to see that kind of continue on, but we are definitely pro commodities as we look forward to next year.
That is fascinating. I think you mentioned this earlier as well, is that the impact of ESG on different financial markets. It is, I think that can be a huge topic in itself, but, I appreciate you making this point again, that ESG has implications for lots of different asset classes, and it's something that investors should consider as they think about their portfolios in 2022.
I wasn't suggesting ESG is a bad thing or climate change is a bad thing, but ultimately the actions of a lot of capital flowing to ESG also means that less capital is going to be flowing into, for example, the U.S. shale development. I think the oil and gas companies in the United States have certainly been more prudent in their management, but at the same time, you have less capital sloshing around to fund some of these developments. So I think that will curtail some of the U.S. Production as we start looking forward to 2022 and 2023.
That's great. So I have huge respect for Katie as a researcher. I know that you're very thoughtful, and I love comparing notes with you. So early this year, we wrote a piece for Investments in Pensions Europe about investing in a low-yield environment, and we found that in rising rates, stocks and bonds typically tend to struggle, and risk premia, they typically perform. There's some mixed results. For example, defensive strategies are not as robust as some other ones. But really, the two strategies that stand out are trend following and also loan-only commodity exposure. So I'm curious. I know that you've thought a lot about investing in an inflation environment. Like, what do you find? Like, do you mind sharing results of your research?
Yes, I've done some research on this a couple of years ago as well, because obviously the only data that you have is the 70s. So you have to wave your hands around a lot to kind of assume that 1970 is the same as today. But what you do find during that period of time is that stock bond correlation is overall positive and that bond volatility is much higher. For trend following as well, I always kind of joke that strategies like this, they like environments where things are, they like change, they like disruption, they like macro uncertainty, and sort of macro volatility. And so when we're faced with a very, very large structural regime shift in the markets, it is not at all surprising to me that strategies that sort of are built to kind of profit from those type of volatility are the ones that people should think about. In terms of opportunity set, a lot of the signals are going to be very much different from what we're seeing in the 60-40 type of risk parity approach as well. So for example, there can be opportunities on commodities going up, and then there can also be commodities retracing from sort of overheated values. Another thing, I loved what Mike was saying, because I've been thinking a lot about commodity prices recently. And if you look at the last month or so, we had a massive retracement in some of the commodity prices. And the first thing people like to say is, see, I told you, they're not going to go up again. It's over. From my perspective, I think it's so much more complex in that you see something like the US dollar actually went up a ton in the last month or so. So 2 months. So you have this interplay also with the US dollar, with a lot of the commodities that we trade that create some headwinds for things like oil prices. But we also saw a massive risk off trade trade, which in some sense, people were worried that we would have some demand destruction because of Omicron. And so that kind of reverted the recent trend in energies, which, as Mike was saying, is a structural trend that we have an issue with lack of supply and we have a lot of demand over the long run to sort of satisfy businesses. And so I think I like that point, short-term versus long-term. The short-term can be very turbulent because you have different forces coming into play, but the longer term is really very much how do asset classes navigate a very different inflation environment when you have inflation as a headwind. And I think that's what we're all going to have to try and think about for the next year or two, is that we have to think differently. And most of us weren't investing in the 70s, probably a good thing, because it seems like it was high, it was a wild time. So yeah, so I agree with you, Mike. Very good. Yeah.
Well, thank you, Katie. Yeah, just to share some numbers, I think that the Black Friday moves were enormous. I believe oil went down roughly 13 to 15%, which is a significant move. So I think the volatility that Mike and Katie are talking about is quite real. So John, I know that you've thought a lot about different types of institutional investors and their needs and preferences. You've also thought a lot about the whole fiat currency devaluation that's happening. So do you mind talking about some of the implications of those?
Yeah, one thing I wanted to go back to what Katie was saying. How are the 70s, different than today? And I think it's worth remembering. Obviously I wasn't there. I was hanging out and in first grade and whatnot. But I think that what we have to remember is that the U.S. was the only game in town, and Europe a little bit. But first of all, you couldn't invest in European equities if you're in the U.S., and you couldn't invest in the U.S. if you're in Europe. Basically, we didn't have a global economy. We had about 5% of the people, the U.S. and Europe, producing 100% of the global tradable assets or global tradable production. And so we're in a very different situation today. Now, I do definitely agree that we're going to see supply chains become more robust and more duplicative, and that may drive up the cost of manufactured goods. But I think that you may actually see a globalization of services. And frankly, those are the things that have driven inflation. They've been inflationary versus deflationary manufactured goods. Manufacturing can actually drive productivity even in the U.S. So I don't know if we're necessarily locked into serious inflation. In addition, the unionization picture in the U.S. is very different. There's no wage price controls yet. Effectively, we have a much more flexible economy. So there's a lot of things that would say that the 70s are very different than today. Now, the question that you actually asked, Murat, since I expect the Fed is going to continue to conduct financial repression, if you have no Bitcoin, get some. If you have Bitcoin, double it. In a world of negative policy rates out 30 years, you need a store of value asset. And frankly, cash used to be able to fulfill that when cash rates were above the rate of inflation, which they aren't and they will not be for the foreseeable future. So I would say that an institutional investor, just directionally in a world of negative policy rates, you should increase your store of value assets, so basically Bitcoin. You should maintain your growth risk oriented assets. If you're thinking about this in kind of like a risk parity point of view, and you should increase your growth risk offset assets like trend following, rates and trading strategies. So that means really you should be decreasing traditional bonds as a percentage of assets, and probably allocating that to digital currency or to Bitcoin, in my opinion. Again, my opinion, not that of my current employer.
No, that is very interesting. I think it would be nice for us to review the poll results pretty soon about digital assets, because I think there's a very significant gap between the digital asset space and institutional investors. It looks like a lot of retail investors, a lot of people that I talk to invest in digital assets, but hardly any institutional investors do that. So I like to pivot to that discussion. And I'd like to start with Mike. Could you please set the stage for us? What is the digital asset space? Is it, I've heard about cryptocurrencies. I heard about blockchain technology. Do you mind demystifying this asset class for us briefly? And just also maybe talk a little about your fund and what your fund offers to investors.
Right. I previously mentioned we have a trend-based fund and a digital asset fund. So I'm more than willing to let John keep talking, be the cheerleader for both types of strategies as we look forward to next year. Excellent job, by the way. So I guess if we were going to have this conversation or had this conversation 5-6 years ago, 5-6 years ago, the market was Bitcoin. I think it was 86% of the crypto assets were in Bitcoin, XRP, maybe a little Ethereum, kind of rounded it out, but it was pretty limited. And I think the conversation was, yeah, there's some cool, innovative technology, but Bitcoin is kind of this digital gold, store of wealth thing. And this is why you should invest in Bitcoin. And I think there was people that said, this makes sense, probably less so about the technology aspect of it. And more so just a store of wealth or, fiat currency. Bitcoin's the better place to be. And I think, that made sense as it started out. Certainly institutions, I think, were interested, but at the same time, it was a pretty small market. If you look forward, fast forward a couple more years, you get to 2018, we started getting close to a $1 trillion in market cap. Bitcoin prices were skyrocketing and, of course, collapsed. If you put together a list of pros and cons to invest in the crypto space, the list on the con side would be far greater than the pro side. It was a little bit of a wild west. Firms were getting hacked into, people were losing their passwords, etc. So there was certainly a lot of cons. I think a lot of that's being addressed, and that's part of a kind of a new and emerging technology. If you look at what's happened the last couple of years, a lot of things have developed to make it what I'd say certainly a more acceptable or institutional product. As mentioned, it's now a $3 trillion value. Bitcoin is less than 50% of it. Other cryptocurrencies have become larger and more dominant in the space. Firms have come across, big name firms, deeper pockets, US based, become custodians for it. Coinbase, certainly more respectable, financially secure, publicly traded company to execute platforms. CME now offering the futures, certainly again, another well-established, well-recognized. There's comfort in having the assets held at CME. So the market has evolved from that perspective. Where I want to start really from is we have a fund, but at the same time, our background is in trading. So our background is not fundamental research. It's definitely on the trading perspective. So as we allocate capital, we are looking for trading opportunities, but at the same time, you have to do kind of the fundamental research that's kind of behind it. There are some disconnects, and there's some things that kind of got arbitraged away pretty quickly. 15 months ago, you could have done a basis trade. So take advantage of the difference between the futures and the cash market and create a spread every month. That pretty much has disappeared, something we monitor on a daily basis, but has disappeared. So Grayscale used to have a huge arbitrage opportunity. That kind of has gone away. So those are all signs of a market that's starting to grow, starting to develop, etc. Keep in mind, I really haven't said much about the technology side of it because that's always kind of been in the background. People always talk about the blockchain. It's tools we need. It's going to be disruptive. But at the same time, it's always been kind of the latter. As we go to this year now, all of a sudden the technology aspect of it, the blockchain part of it, has become more and more important. Some of it has been manifested in the Ethereum blockchain using the non-fungible tokens, NFTs, as described. Early this year, artwork, NFT artwork, or digital artwork, became popular and discussed, right? Now we could argue on a collectible, what's the value of that, but who am I to say what a value of something that's collectible or not valuable is? No different than wine or art or collectible cars or digital art. But I think that component of it will continue to be developed. I know a gentleman that is selling part of his asset management firm via NFT, and he's going to get part of the cash flow from it. You could argue what the valuation is appropriate, but I think it's kind of a neat concept and could be kind of a sign of what's going to happen in the next 5 to 10 years. So as it relates to what we do, we are quantitatively trading both Bitcoin and Ethereum futures, but at the same time, we're also discretionarily trading another basket of a couple dozen different smaller DeFi tokens.
Thank you. Yeah.
We typically will look to buy the bottoms and sell the tops in that.
Yeah, thank you, Mike. That was a really fascinating introduction. I think we're going to go back to it a little bit more just in a little bit. But so I'd like to ask a final question to Katie, and I know that Katie, you need to go soon. But why would institutional investors be concerned potentially with investing in this asset class?
I think the challenge in crypto is just not that it's not exciting. It's just very high volatility. And I think that people are learning more about it. And I think there's going to be more and more opportunities. But I think in terms of volatility, it's still something that we as risk managers and very obsessed with risk haven't figured out how to manage that risk yet. So I think that's all going to change. It's just going to take time and learning more and working with those that know a lot about it. And given that, I'll pass it back. And I'm sorry, I have to leave at this point, but I want to thank Meg, and I'm going to leave Mike and John to have it out more of talking about cryptos. Thanks so much for having me, Marat. And I wish everyone the best in managing inflation in 2022. So
thank you so much.
Great to see you, Katie.
Bye.
Okay, so let me throw a couple of things that potential objections to the investing in the digital asset space. So what I find, I've talked to quite a large number of managers who specialize in building digital asset solutions, and I also talked to a number of institutional investors. And there seems to be a huge disconnect between the digital asset manager and investors because they just don't seem to be speaking the same language. So when I think about an institutional investor, it is somebody who is accountable to their board, and the board is not typically a group of computer geeks who wear shorts and they're about 25 years old. They're typically people who have been very successful and very thoughtful, but their backgrounds are typically in traditional investments. They understand stocks, bonds, valuations, they understand alternative investments. So for them, if you start going into the details of protocols, you completely lose them, right? If you talk about smart protocols, smart contracts, you lose them as well. And, but they do understand questions such as, liquidity provision and compensation, cost of capital, things like that. And they also hear some headlines. They hear headlines about hacks, about some of the custody issues. So I'm just wondering, I know, John, you're planning to move into this whole new world of digital assets. So what are some of the big risks that you see that institutional investors should consider going to the space? And also, if somebody really wants to invest in Bitcoin, what's the best way to do that?
That's a great question, Marat. Well, first of all, if you want to be long Bitcoin, there are a number of ways to do it and a number of ways that are very, very safe. If you want to basically own Bitcoin for the short term and make certain it's 100% liquid, or own the price change in Bitcoin, then you want to be basically rolling Bitcoin futures. Okay, so you could set up easily an account with with Efficient, or with Mike, or a CTA account that just rolls Bitcoin futures long. Now there's no discount to that. That's going to be at the Bitcoin price. And so you might say, well, I want that because I want every day to be at the price of Bitcoin. I want to be able to close out my position every day. So if you want that, basically that's the way one would do it. And everyone has future accounts. Most institutional investors are okay with CBOE, Bitcoin account, with a CTA. Okay. If you basically want a 15% discount on Bitcoin today to the trading price, you can buy Grayscale GBTC, publicly traded stock or closed-end fund that basically just holds Bitcoin, and you pay 2% a year for the privilege. But at a 15% discount, if you're going to hold it forever or 7 years or whatever, basically over 7 years, I do expect that we're going to see an at-the-money ETF conversion of that fund. Okay, great. And then there's also ETFs that are at the money, but if you're an institution, I wouldn't recommend that. Even though there's like $1 billion in those ETFs right now, effectively there's a less expensive and probably better way to do it through just a commodity account. So those are the ways to get into Bitcoin today. What Katie indicated was interesting. Bitcoin is volatile. And from my work in the crisis risk offset space, I always approached this from the point of view of you want volatile assets as long as they're not correlated. So basically, if we have stocks volatile and we have long bonds volatile, how about Bitcoin volatile? As long as these things long term have very, very little correlation with one another. And in my opinion, I see that, this global store of value, Bitcoin is really, in my opinion, very different than, it has won the race in global store of value. And I think it will continue to hold that place, as an instrument. So I think that basically we're going to see Bitcoin, as a global store of value now and in 25 years. There's going to be a ton of other things occurring in the crypto space, but as far as that function, global store of value, I see Bitcoin as, in a sense, having won that race, and there's so much capital defending that and so much invested that I don't see, others, basically being able to break in. It's a secure, decentralized global store of value, analogous to digital gold. And I think that's a great analogy. But it's better because you can transfer it, because you don't have to guard it with machine guns. You can basically, if you wanted to be long Bitcoin, which I think most institutions should be, you could basically purchase your Bitcoin and then bury it at a vault somewhere, in Switzerland or at US Bank, the private keys, and basically you've just got long Bitcoin forever. So, the hacking problem is if you hold it on exchange, and those exchanges can be hacked because they hold the keys and they may not have the security protocols that you might want, but it's in their interest too.
Yep. Well, thank you. So really, I think that you've already given us the really valuable suggestion, which is that people should seriously consider exposure to crypto. Well, I know that we only have a few minutes left. So, Mike, I know we covered a lot today. We talked about inflation, low yield environment, commodities, digital assets. So if you were just to leave this discussion with one key takeaway or one suggestion for the audience, what would it be?
One quick follow up to what John was saying. Fidelity Institutional did a survey of crypto holders. The two reasons that they hold crypto: one, it's an uncorrelated asset class, and two, it is an innovative technology. And I think if you think about those two things, much like all the investments that are flowing into the EV market, EV charging market, everyone has kind of concluded that it is a legitimate market going forward, and certainly a high growth, high demand market. At the same time, We're not exactly sure who the winners and losers are going to be, but yet at the same time, there's something there. There's some technology there. And I think if you look forward as in the next year and holding a position in Bitcoin, be it in an ETF, rolling futures, I think Wisdom Tree's going to come out with a managed account shortly to hold some of the bigger cryptos. I think it makes sense if you look at it strictly from the standpoint of saying, here are the two main reasons why I should be holding crypto going into next year. As it relates to non-crypto, we are certainly looking forward. This year's been a good year in the commodity trading space and in the trend following. We think next year will be equally as good.
Thank you, Mike. Well, so I think that we covered a lot today. I'm sorry we were not able to cover as much as we're hoping to. And we had several Q&A questions, but we kind of tried to address them during the discussion. And unfortunately, we did not cover all the aspects of, the blockchain technology and talk about some of the maybe more esoteric ways of trying to generate returns in that space. But we talked a lot about the challenge of inflation, that it's likely going to be persistent and it's here to stay for a while. And it's important to consider what the implications are for the portfolios, because the environment going forward is quite different from what we've seen for the last 40 years, which was like a low inflation environment, declining yields, asset prices, growing up across the board. And now we're in a situation where we're seeing potentially negative expected real returns for several asset classes. It's a real challenge. So I appreciate that the panelists gave some specific suggestions about maybe looking at commodities, looking at trends, maybe looking at some digital assets to help solve that problem. We also talked to this really booming asset class of digital assets. And we tried to talk about a little bit about what it is and also some of the ways that institutional investors can participate in this asset class and improve their portfolios, which is once again quite relevant given the environment that we're in. At this point, I want to thank the panelists. I know Katie left, but we're lucky to have her. Thank you, John. Thank you, Mike. It's been a pleasure. I appreciate you taking the time out of your busy schedule to share your advice with the audience. I want to thank the audience. Thank you for listening to us. And please feel free to follow up with the panelists or me after the call. I want to thank Meg for organizing this fantastic event. Thank you so much. I know that you're always thinking a lot about how to benefit the investment community and how to help investors make better decisions. So thank you for organizing this event.
Oh, a real pleasure. And I got to tell you guys, that was really one for the books. That I hope all your sign-offs come in quickly, because I'd like to get that up on our website and really get that out. It was so thoughtful, so forward-looking, these game changers, that you were talking about, and all the ways that people need to really seriously think about repositioning for the future. You just approached it with such clarity, and it was just excellent. And I thank you all for your time. It was lovely to see that come together. I can't believe we've come to the end of our series, but clearly it's time for everybody to take a break and a sigh and close out their year and have a lovely holiday and ease on into a new year and celebrate a little. Hopefully this new variant will be tameable and we can get back out there and start to get together again next year. I certainly look forward to that. Murat, such a good job. John, Mike, fabulous commentary. I wish Katie was still on. She's on Yahoo Finance right now, but she was fabulous. Thank you so much. And I hope to see you guys all really soon.
Thank you.
Thank you, everybody.
Happy holidays.